Good morning and welcome to this week's edition of Winston's Weekly, covering all things property. I'm Manny Anton, your host for today's property chat. Winston, welcome back.
Thank you.
Winston, why don't we start with an update on this week's property news. This week has seen the last lot of property names report, a few stragglers. Any highlights from these? Anything we should be aware of?
Well, I guess now that they're all out of the way and there weren't any major REITs announcing results this week, but the last few laggards were some of the smaller ones. I guess looking at the picture overall, there are a couple of things that come out of it, and I'll talk about each property subsector separately. The standout was the industrial sector, with Goodman Group coming out with a very good result. And as a result of that, the stock was in favour and it appreciated.
There was no surprise in that, though.
No, there was no
always
surprises
a
whatsoever.
view that industrial...
but the fact that they're concentrating now more so on data centres, which is a big growth area, has helped them. But the other bit of news which came out yesterday was that Goodman Group is now in one of the global indices, the REIT indices, which hasn't been in before. And that also gave it a bit of a kicker. So,
what indice is that?
I think it's the REIT, one of the large REIT indices.
Okay.
Yeah. So that's the industrial sector looking reasonably good. Let's now talk about office, which really what we've seen in the results in office is cap rates continuing to move up, valuations continuing to go lower, and that's expectation that will continue into the June half year, the June period results. So we expect some more adjustments to valuations. Maybe they may well be the last ones, right. And probably in the area of cap rates are going another 10 to 15 basis points. Obviously, occupancy is an issue, and we've also seen this week that the Fair Works Commission has in fact accepted an approach to put working from home into agreements with employees. So that's going to be an issue in terms of getting people back into the office, which, in my opinion, we're not going to get a situation where everybody will be back in the office 5 days a week. So office is still a little bit of concern. Retail has been pretty well. The results were well received. Foot traffic is up, turnover is up, and releasing spreads are going the right way. So from that perspective, retail is looking okay. We may still see some issues with cost of living pressures and adjustments to CPIs when they come out, but I think it's probably over the hill, as it were, in terms of the issues with the retail sector. Retirement living, I'm not talking about aged care, I'm talking about retirement living, which is government supported. There's been a bit of a slowdown in settlements because people, what they basically do is sell their existing home to buy a smaller place, a manufactured home in most cases. Because of the issue with the cost of living pressures and higher interest rates, settlements of them selling their homes have been protracted, which means the settlements with the operators, the property operators, have been pushed out. So that's put a little bit of pressure on those retirement living operators. But I think that they should be okay. So much so that the Lifestyle Communities, one of the largest operators of manufactured home estates, came out last week with a capital raising because of issues with rising debt costs and slowing settlements. But apart from that, overall the sector itself is in good shape. And if we are looking at lower interest rates over the course of the year, not immediately, it should be in a good position going forward.
Okay, and sort of looking out in the remainder of 2024, what do you expect? Like, how would you position yourself? I mean, given what you've just described.
Well, again, we have a preference for retirement living. We have a preference for childcare centre. Again, both of those are government supported. So we see that continuing to be in good demand going forward. Retail is probably something that we're looking more closely at, but concentrating on cost of living, adjustments. So we're looking at non-discretionary as opposed to discretionary, not the big malls. The other interesting thing is that there has been some activity in terms of transactions taking place, but they've been in that under $100 million price tag. So some of the smaller offerings around, whether they be retail or whether they be office, they have been taken up. But the larger ticket items are still a bit slow to get through.
Right.
So we think the outlook is reasonable, and if you're willing to sort of wait, this is the time to be increasing your exposure.
So, Winston, in terms of M&A looking forward for the rest of 2024, what are you expecting? Are you expecting to see a lot of activity? If so, what subsectors would you expect to see it in?
Yeah, I think there will be more activity. I mean, we've got 2 M&A actions at the moment in Newmark Property Trust and in Euree, and I expect to see a lot more going forward. And they'll probably be targeting those smaller groups and operations where they're trading at reasonable discounts or larger discounts to NTA. Office, to some extent, some of the office funds around. Retail, things like RAM Essential Services. It's got an NTA of 92 cents. It's trading at 66. It's yielding about 6.5–7%. So they're the sorts of things that that will be in focus by a lot of the groups who are looking to get larger. Okay.
And you did just mention BWP Newmark. Any updates on what's happening there?
We are progressing with getting to the 5% level in terms of calling for an EGM, and we're in the process of getting to that. We're around the 4% level. Just waiting on some replies back and some people to sort of commit to what we're trying to do.
Okay. Well, Winston, thank you for your time today, and we'll be back with another edition of Winston's Weekly next Friday.
Thank you.
Until then, have a great day.